7:30, I think we should just roll.
Yeah, let's do it.
Okay, cool. And if they want to catch the beginning through the recording, they can do that. So, well, hey everybody. I think you already know this, but I'm Valerie Moseley. I'm a CPA. I also do have a background in the arts. I majored in music in college and have a certificate in theater and performed a lot as a physical comedian and tap dancer. So I gotcha. But it's been a minute since I've been a performer. So it's kind of in my past. Though I'm currently for fun taking an improv class. So so I have kind of a rundown that I'm gonna walk through, but I would love to hear just off the bat if there's anything like, if I left this presentation knowing this answer, I would feel like I really, was satisfied and really happy with this event. If you want to shout out to me like what your burning questions are now at the top, then I can gear the presentation towards that.
Deductions.
Deductions.
You know what?
Okay, gotcha. All right. So can you guys help me out? I assume that a lot of you are both contractors and employees. You're earning wage income and gig income, is that right? Seeing nods. Okay. Or just contractors. Right. Okay, gotcha. All right. So I will speak to both of those. And just I'll just say right off the bat, under current tax law, which is actually scheduled to expire at the end of 2025, there are no deductions for employees. When that law changes back, if it does, obviously our government is in quite a chaotic moment, but it's very likely that Congress will take some action to keep some of the current tax law in place. Because there's some major things that are set to expire at the end of 2025. So those deductions for employees are just a one little tidbit of a whole lot of tax laws that came into play in 2018. And so the way they paid for that tax law was to have a lot of things expire so that they wouldn't cost the government a whole lot of money down the line. So there are some provisions that are not, the Congress is not going to want to let expire at the end of 2025. So we're going to see a major tax bill come down the line somehow, some way. So I don't know if deductions for employees are going to come back. But if they do, the procedure that you're going to take is to divide your deductions between your contract income and your employee income. And you generally, any reasonable method is fine. Obviously the expenses that would be directly related to the one income or the other would be directly set against that income. But for things like, I joined some society, or I paid for some supplies or something that really apply to both your wage income and your gig income, then you would want to prorate those. Usually by the amount of income, if you earn $5,000 here and $10,000 here, then you take 1/3 here and 2/3 there. I won't go into a lot of detail about how you take those deductions for employees, but I'll say that even if the law does change, the deductions land on a kind of an obscure part of the tax return. So they're not very easy to take anyway. And I don't mean just administratively, like the paperwork is hard to fill out. What I mean is that there are so many limitations and if-then statements piled on top of those deductions before you're allowed to actually get a tax benefit out of them, that a lot of people don't actually end up taking them anyway. So, okay, so let's dive into the world of the gig worker. I'm going to actually pull up a quick little slide here to show you, not slide, PDF. I have here this entity chart that I show people, and I'm not really going to go through this right away, but what I want to point out to you is over here, there's a bunch of words for the same thing. So you could be a sole proprietor, a freelancer, a gig worker, a 1099 contractor, or a single owner of an LLC. Those are all the same thing in the eyes of the IRS. So you might hear different terms on different days. You're talking to different people. Already just now, I've said contractor, I said gig worker, I said, so all of those things, they're all the same thing. And what happens is all of them get taxed on Schedule C. And Schedule C is just a secondary schedule. It's like adding just more pages to your personal tax return. Schedule C does not get filed separately. It's not a separate business filing. Let me grab it here. It is here. So Schedule C, profit or loss from business. So we're just going to spend a few minutes walking through this form, and we'll answer a lot of your questions about deductions. So, but let's see. Do I want to do this first or last? Yeah, I'm going to do it first. So I said that Schedule C is part of your personal income tax return. So one of you said you get kind of PTSD looking at this Form 1040. I get it. That's the big personal income tax return. And unfortunately, due to the whims of Congress and the Internal Revenue Service, the form changes a little bit or a lot every year. But right now what we've got is where the income is reported in this first section, but maybe 4, 5, I don't know, something like that, years ago, they abbreviated this income section. And instead what they did is they threw a lot of it over to Schedule 1. So what happens is you fill out Schedule C. You fill out Schedule C, which we'll walk through. That shows you the profit or loss from your business, from your freelance activity, gig working, whatever you want to call it. And then that rolls up into line 3 here of Schedule 1. And then we do all of Schedule 1 here. Oops, didn't mean to highlight all those. All of Schedule 1, and then all of that rolls up into Form 1040. So you can see additional income from Schedule 1, line 10. Why they make you do this dance is pretty silly. It's because some congressman decided or senator decided that we needed to make the Form 1040 like a postcard and really small. And so then they just shoved more, they made the front of the page shorter, but then they still need those lines, so they just barfed them out to another form, Schedule 1. So stupid. So the point is, if maybe you're using TurboTax or something like that, you're gonna have to kind of trace your income around the forms when you're double checking the work. Okay, so let's walk through Schedule C. Let's see if I can figure out where it is. Yeah, there we go. Okay, so the first part of it is just your demographic information, your name of your business and so on and so forth. If you have an employer identification number and EIN, you would put it in this box D here. You don't need an EIN. You would only usually get it if you actually are an employer. That's the E of EIN is employer identification number. But sometimes people get it because they have to give a W-9 when they are working as a contractor, and they don't want to put their social security number out in the world, and so they go and get an EIN instead, and they use that as the business identifier for their business, the tax ID number for their business. If you want to apply for one, you go onto the IRS website and just, put EIN in the search box, or federal tax ID number. You'll get there. The weird thing is there are certain parts of the IRS website that are not open 24 hours a day, and that's one of them. I know it's really weird to have a website that's not open all the time, but it's not. So you'll need to read the hours. I always have this image in the back of my mind that there's actually little people working behind the computer screen. They can't be there all day long. I think it actually is literally something like that. I think the forms come through and somebody has to process them. So, okay. So next is the accounting method. Pretty much all of you are just going to click the cash button. Any of you guys selling merch of any kind? Maybe, okay. If you're gonna be selling merch, there's a couple of ways to track that inventory. If it's not a big part of what you do, then you can just still check the cash box and not worry about it. If it is a big part of what you do, then you might check the other box and then put in the word hybrid, because then what you're gonna do is report everything on the cash basis, which I will explain in a moment, and then your inventory might be on the accrual basis. I know those are like technical terms. I don't expect you to know what those mean yet. But I will explain as we get lower into the part one. Okay, so did you materially participate? Don't worry about that. The answer is yes. Acquiring the business in 24 or not, you can answer that. Did you make any payments that would require you to file a Form 1099? Who can tell me in the audience what a Form 1099 is?
It's when you're paying a contractor.
Yes. So you report both to the contractor and to the federal government, this is how much I paid them during this year. And so then everybody knows, and the IRS will have a matching notice. Their computers will match that up, and it's gonna look for that income on their tax return.
It's only if it's over a certain amount though?
Which is $600, yes. And also it's only if you're paying an individual, a partnership, a single owner LLC. You do not have to give 1099s to corporations. Unless they are a law firm, always you give one to a law firm. How would you know if they're a corporation? How do you know what their federal tax ID number is? You get a W-9 from them. So before you have anyone start working for you in your business, make sure you collect a Form W-9 and have them complete that, and you'll have that in your records. So it's ready to go. And then every January, you would look back in your records and say, did I pay anybody more than $600? Oh yeah, oh great, I have their W-9 and it has their name and their tax ID number on it. So I'm gonna go and fill out a 1099 NEC, and that's gonna show how much I paid that person, and I'm gonna report it to the IRS and to that person, and then keep a copy in my records. So these questions I and Jay here are trying to catch you, to remind you to do that. That's the nice way of putting it, or to give them a nice big red audit flag. If you said, yes, I made payments that would require you to file a 1099, but no, I didn't actually file that 1099, that's like, dear auditor, please come in. So if somebody deserves a 1099, you should give them a 1099. And word to the wise, please collect that W-9 form from them at the beginning of your relationship with them, not at the end, because it's too hard to chase them down in January. Like if we're gonna be here in, March, where somebody's working for you, maybe they're doing some graphic design work for you, or they're gonna build a track for you, something, then you wanna collect that W-9 from them right away. Question.
Which line in the expenses do we do if we have multiple contractors that don't meet the $600 threshold?
You're still gonna, you're gonna put them in, oops, that was fun. You're gonna put it all in contract labor regardless of whether they, no. Control Z, you're gonna put all of it in contract labor, whether it's 1099 eligible or not.
Okay,
It all gets lumped together in line 11. Great question. Yeah. Okay, so let's hop down to the income portion. So the big number, and the main one you're going to use is line 1 there, gross receipts or sales. So that's just all the money you collected from all your gigs and customers and clients and all your freelance work, not your wages. Your wages do not belong here. Wages have nothing to do with this form. So if you get W-2 wages where you're an employee, does not go on here. That's not where this lives. W-2 wages when you're acting as an employee, Those just go right here on the, right there on the front of the 1040. Total amount from Forms W-2, box 1. Okay, so nothing related to your employment goes on this form. Just your freelance, gig, 1099 contractor, single owner LLC, whatever you want to call it. Okay, so line 2, returns and allowances. So if you gave them a discount or something like that, but most of the time, or we just ignore that line because you just sum up all the cash you got. Now, cost of goods sold. So that is where we pop down to line 42, and we have a whole cost of goods sold section here. So this is the part of the form that we would use if you sold merch, if you sold like t-shirts or hats or anything. And so we would just walk through this. If you were somebody who had a significant amount of inventory, then you would actually need to track how much you paid for it, how much was left on hand at the end of the year, and you don't get to deduct the part that is left on hand at the end of the year. So if I bought like $2,000 worth of t-shirts and it was, I'm just gonna make it super simple, not realistic. I bought 2,000 t-shirts for $2,000, so $1 a t-shirt. And at the end of the year, I had 800 t-shirts left. Then I would get to take a deduction by walking through this cost of goods sold section. The $1,200 for the 1,200 t-shirts that I sold. I would not get to deduct the whole $2,000, just the 1,200. So that example is not good because first of all, t-shirts don't cost $1, but second, $2,000 is kind of small potatoes. I wouldn't worry about $2,000. You might just say that's supplies or materials and deduct it as a normal operating expense. But if you run a business where inventory is like how you make your money, then you'll need to be filling out this portion of the form. Okay, so then we arrive there at gross income. So you're just taking in your gross receipts, all of the money that you received, subtracting off your inventory that you're allowed to deduct in a year, and that arrives at this word called gross income. So from there, we get to deduct all the operating expenses, which is the reason you're here for this workshop. Okay, you want to know, what can I deduct? All right, before I dive into the line items, I just want to say a couple of things. One is that Code Section 162 allows for any deduction that is ordinary and necessary that was incurred to help you earn the money that you're being taxed on. So Congress knew that they couldn't possibly enumerate every single possible deduction because life changes and things move on. So rather than them trying to say, this is deductible, this isn't, this is deductible, this isn't, they just said anything that is ordinary and necessary. So you can imagine things that are extraordinary, but still seemingly necessary, or vice versa, that are like, well, this is an everyday item, but I don't really need it. So the necessary kind of tends to weigh a little bit heavier. We tend to lean like, if you needed it to earn the money, then it's generally tax deductible. But there were one of the court cases that I read a few years back, I always give this example, so forgive me if anybody has heard this before, but there was a court case where a company paid money to have some of their they've been in business like a couple hundred years. They had paid money to have their memorabilia, couple hundred? More like 100. Anyway, paid money to have their memorabilia pulled out of storage and like filling the entrance to their lobby. They did not get to deduct that expense because the auditor said like, well, how does that generate income? Doesn't help you generate income. I think they did a poor job. They should have made it like the lobby that was open to the public, and that it was like, putting out the brand of the brand story of the company. But that's an example of how something could be seemingly ordinary, moving storage around, maintaining your personal effects, but was not deductible because it wasn't really needed to run the business. So with that in mind, the second thing I want to say is that the IRS has built this form based on their best guess of what you might deduct. But they haven't revised this form in a long time. So there's a lot of things that you could deduct that are not on this form. And that's why the second page is full of blank spaces for you to fill in other expenses. And you can add pages and add pages and add pages, whatever works for you. So let's walk through a few of the deductions, because there are some that are specifically excluded. There are some that are allowed, but only with enhanced documentation. And then there's the rest, which are just allowed. So advertising is one that's like just allowed. You can take it. And you can think, you might expand on that. Do I have a website that I host? Did I pay someone to design that website? Did I pay to have, a Google account? Whatever. All of that is needed to run your business, and yet it's not going to be here on Schedule C, because how could, the people who designed this form in 1978 even knew that Google was a thing? I'm making up 1978, but it's probably something close to that. So I'm not going to walk through each one of these, but let me just highlight a few of them for you. So I mentioned there's like everything's deductible with enhanced documentation, and not deductible. So let's find the ones that are deductible but with enhanced documentation. So one of those is car and truck expenses. That's probably why it says see instructions, because in order to take a car or transportation deduction, you need to track your miles. There are two methods for taking the car deduction. One is to do what's called the safe harbor method, the easy peasy method, the mileage method, whatever you want to call it. And then the other one is like the full-blown method. So either way, you have to track your miles. But with the easy method, you just track your business miles and multiply it by the current published mileage rate, and that's your deduction. I think we're up to like 65 cents a mile, something like that. You still need a log though. You have to have a log of every single trip. You can do that digitally, or you can do it manually. You can do pencil and paper. There are apps that do it, whatever you want, but it has to be tracked. You cannot just think it up in your mind. Oh, I probably drove a couple thousand miles this year that's not even sort of allowed. It has to be actually logged. I went here, and I went there, and I went for this purpose, and it was this many miles. The hard method is where you not only do all that work, but then you also track how many miles you drove for the car the entire year for any purpose, and that becomes the denominator of a ratio. So the numerator is the total miles, the top number, the numerator, is the miles driven for business, and the denominator is all the miles driven in a year, and then that gets applied to all the costs for the year, whether that's gas, oil changes, repairs, maintenance, et cetera, et cetera, et cetera. And includes a deduction for depreciation, which I will talk about in a little more depth. But depreciation is basically a made-up calculation to give you a little tax benefit for just generally using up the car. Let's see, is there some, yeah, it's just a complicated tax calculation that's just written into tax law that just says, oh yeah, okay, if you're gonna use the complicated method of taking a car deduction, we're gonna kick it out to you, we're gonna give you a little bonus, taking a little extra tax deduction by walking through this complicated math. Your tax software or your tax professional will do that math for you. I don't recommend you do it on your own. So generally, you could see I prefer the mileage method or the easy method, the safe harbor method, because all you have to do is just track mileage in that log, multiply it by the mileage rate, boom, you're done. And usually that mileage method is quite beneficial. It's not even that much better of a tax deal to do all that complicated work. Okay, moving on. So I just mentioned depreciation, and that is a line right here. So you don't need to sweat depreciation or even think about it if you don't buy anything for your business that costs more than $2,500. If everything you buy is less than $2,500, you're not going to use line 13. If it costs more than that, then you're going to need to do some depreciation calculations. So just like I gave in the car talk there a moment ago, every piece of equipment that you buy for your business that costs more than $2,500 is supposed to be depreciated. And that means you walk that equipment over to some complicated math that basically says, look, we know this equipment is actually going to last you more than 1 year. And because of that, we're not going to allow you to take the entire cost of it as a deduction in the year that you bought it. That's just not really right or fair. We should spread it out over the several tax years that you would be using this piece of equipment. So that's why depreciation is so complicated, because it's actually taking this thing and you kind of have to keep track of it. You have to say like, okay, well in 2024, I bought this like $6,000 piece of equipment, and it's according to the tax rules, it's a 5-year piece of equipment. So I have to spread $6,000 over 5 years, and I have to keep track of it and remember to deduct it 20% of $6,000 every year. It's kind of a lot to manage. So there is something called Section 179. It's an election using the Internal Revenue Code, Section 179, that says, look, I know and you know that I'm supposed to spread this cost out over these 5 years, but that sucks. So I'm just going to take it all this year. So that's why line 13 says depreciation and Section 179. So most people take 179 so they can skip this hassle of having to spread the cost out over those 5 years or 7 years or 15 years, or there's some property that's even 39 years. So you can imagine that that's like buildings and stuff. So I assume you're not buying a building in your business. Okay, so moving on, employee benefits and insurance, both of those might make you think of health insurance. If you're paying for your own health insurance, this is not the place to deduct it. I'll show you later where you do deduct it. It's not here. So don't deduct your own health insurance premiums on line 14 or 15. You would only use line 14 if you had employees. I'm going to assume you don't. And insurance would be like business insurance, or you might have like insurance for particular gigs, like if you had to like insure like to attend a festival or something, that would go here. Okay, so I'm want to scan for any other special deductions that require, yes, okay, so here we go, travel and meals. I do not like that they put those together because, well, yeah, never mind, I do like it. Okay, so travel and meals both require enhanced documentation. So for that reason, they can be put together. The funny thing about meals, though, is not only do you have to have enhanced documentation, but also only 50% of those meals are deductible. So you would add up 100% of your meals for the year, you know, taking your business manager out for lunch, taking your buddy out to dinner to talk about your, I don't know, future plans, taking your band out for, you know, a planning meeting, whatever. Those are all deductible. And also meals on the road, like if you, okay, we're gonna go, you know, again, we're gonna attend a festival in Oklahoma, randomly making that up, then your meals on that trip would also be deductible. But you do have to track all the details. So the place, the purpose, a dollar amount, the, you know, the name of the restaurant or the taco truck or the whatever, save your receipts. You have to document those meals, like the purpose, the place, the time, all the info. Travel similarly. So if, you know, what did I say, Oklahoma, you're gonna, you know, take a road trip out to Oklahoma. So you're gonna track your miles for that, you're gonna track your meals for that, and you're gonna track like all the hotels or Airbnbs or couches or whatever's that you stayed on and paid money for. You actually have to save that documentation. Okay, yeah, we stopped in San Diego on the way to Oklahoma? No, but anyway, we took a side trip. We stopped in San Diego and stayed at this place. We're gonna, we have to keep that receipt. We stopped in Nevada, stayed at this place, keep that receipt, so on and so forth. So those ones where, you should keep all your receipts, but with the travel and meals, you have to document the place, the why, the how, the where, the all, the everything, and have your receipt. Okay, so you can see here also there's a line for other expenses, line 48. So that's where you're gonna add up all the extras from here. So you can have all kinds of extras that the people who designed this form have not thought of. I already came up with just your website, your graphic designer, it could be your guitar picks, your straps, all those everythings would go down here because they never thought of it. Yeah.
The value for meals, are we putting the 100% or the 50%?
In that line, you're gonna put the 50%. Yeah. This form actually changed a little bit. It used to have a place for you to actually do the math on it, but it's another one of those see instructions, which means you put the 50% there on line 24B. Okay. Yeah.
I sometimes buy stuff for my work off of Facebook Marketplace.
Mm-hmm.
Is that also still deductible, even though it's like used from someone else?
Yeah.
Do I deduct the face value price or the price I paid for it?
How much you actually paid for it? Yeah, great question. There is if we have time, you got a handout, I think, and the second page of that handout crammed on there is some information about Washington state taxes. I didn't really leave time to talk about that today because I don't think most of Washington state taxes are going to apply to a lot of you. But there is one little tidbit that reminded me of. So if you do kind of get caught up in having to file a Washington state business tax return, as you know, Washington state doesn't have an income tax, right? But it does have a business tax, B&O tax. And so if you kind of get caught up in that regime into filing, and I say caught up because you would need to be a legitimate business person, you have to get a business license and all that stuff. And so then Washington state's going to be like, hey, you exist. You don't have to get one in Washington state if you have less than $12,000 of revenue. But if you have more than that, then they're going to be like, hey, you should start filing or let the Department of Revenue know that you exist. And then, but the thresholds for having to pay tax for B&O tax, Washington state business tax, they've gone up recently. So I actually have this handy. If as a service provider, you'd have to have $128,000. That's hard to see. $128,000 of revenue before you would owe any Washington state B&O tax. So a lot of folks who are pulling in less than that, they just send you a letter and say, stop filing, don't sweat it. But there is a funny thing where if you are supposed to file a Washington state tax return, they're going to ask you about the sales tax that you've paid. So Washington state basically runs on sales tax. If you look at the pie charts, it's like 2/3 or more, of our state revenue is sales tax. So the auditors are they've been trained to ask deeply about sales tax. So where am I going with this? So if you purchase something, generally there's a sales tax on it. You go to the grocery store's a bad idea, bad example. You go to Office Depot, you buy a ream of paper, you pay sales tax, right? You go to the furniture store, you're buying a stool for your studio, you're gonna pay sales tax. And the sales tax is imposed on the end user, the final consumer. But it also is imposed when something is sold used as well. So if you're buying something on Facebook Marketplace, you're probably not paying sales tax. So if the Washington State ever audited you, they would probably ask you to pay sales
That
tax
makes sense.
on that Facebook Marketplace purchase. Which is a good reason for all y'all to be saving your receipts no matter what. So the IRS, they're a little bit chill on saving receipts for some of your lower cost items. But Washington State's not chill. If Washington State audits you, does a business tax audit on you, they're gonna look at literally every single receipt and look that you paid sales tax. And if they didn't, they're gonna charge you the 10.3% or whatever it is in your little neck of the woods. So that's really painful, right? Can you imagine paying 10% on top of all the stuff that you bought that year? And also when Washington State audit you, they audit you 4 years at a time. So you would pay the sales tax for all 4 years of purchases. So save your receipts. Okay, how are we doing? Do y'all need like a jumping jack break? Or
I'm feeling good.
okay, cool. Okay, so why don't y'all shout out some other things that might be deductible in this, like other expenses?
Phones, internet, vehicle notes,
Vehicle notes.
like your car payment, not just mileage.
No, not allowed. I love that. See, this is why we're doing this. So you can't deduct the car payment. You either do the mileage method, where you just deduct the miles that you drove, or you do the whole thing where you collect the gas receipts and the oil receipts, the oil changes and the windshield wiper and the repairs and the maintenance and the interest on your car loan and the depreciation, blah, 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 all that. So it's one or the other. You do not say like, oh, we drove out to Spokane and I bought like 3 tanks of gas, so I'm gonna deduct that. No, not how it works. Sorry, I'm being kind of adamant about that, but I see people do it like all wrong all the time, and then they get in an audit or like get a little IRS notice that they have to respond to, and it just does not fly. You need a mileage log that's very well documented and basically nothing else.
Can I ask a question related to that?
Yeah.
My accountant told me last year, because I commute really far to get to here to work. And so, but I'm a contractor here, right? And so my CPA told me that I wasn't allowed to deduct those miles to come to work here as a contractor.
That's right. Well, I don't know that that's right, but the point where I think that person's getting, where they're
Going
getting.
to rehearsal was okay, like going to gigs as a musician, which I have I'm a sole proprietor, so that was fine.
Yeah.
But I couldn't believe it. I was like, what?
Yeah, because they probably figured out this is kind of your tax home. And you don't get to deduct trips from your home to your tax home.
Okay.
And
Tax home.
yeah.
Is this my tax home?
That seems odd because she's not a W-2.
Right, but you can still have a tax home be outside your home, even as a contractor.
Wait, could you explain that a little bit more?
Yeah. So let's say I work as a contractor for the telephone company. I'm just like the person who like shimmies up the poles and just fixes them. So obviously I'm not working out of my house because I have to be up the poles, right? So my house can't be my tax home. So even if they send me out to all these different locations, I don't have a tax home at my home. So I can't, and there's a general rule that disallows commuting as a deduction. So wage earners, like, the classic thing, okay, I live in Wallingford and I, work downtown at Amazon. If I drove from Wallingford to Amazon every day, that would not be tax deductible because that's considered non-deductible, like personal commuting. So it's your first trip that isn't deductible there from your home to your tax home. So your tax home for the W-2 Amazon employee is like, they get pulled back to downtown now.
Right.
At their that's their tax home. But indeed, you get to you go to the gig. You even drive to the bank to drop off a check, deductible. You drive to that business lunch, deductible. You drive to Spokane to go to a conference, a music conference, deductible. All good, just not that commuting, that everyday commuting. Now, if it was established, and you know, I don't know, maybe you and your CPA need to work this out, but it was established that your home is your tax home, then that first trip is deductible because it's not personal commuting, because your personal commuting is just going, oh, good morning, I got out of bed and then I walked into my home studio or my home office. Like that was your commute, right? And then everything after that is deductible, or is a tax deductible or loggable trip. Yeah.
How often, because I have some people that I work with where I'll commute to the same location maybe like 2 times a week, and then I'll not hear from for a month, and then 2 weeks straight I'll be there every day.
Mm-hmm.
I mean, not where it's like definitely considered a commute, but where's that line of like, oh, it's
Yeah.
no longer a tax home, it's a tax home now?
Usually, well, if you can establish that you've got a tax home in your home, then you wouldn't need to worry about kind of how frequently you went to those other folks. So that would be kind of a question of like, do I, keep my books and records at my house? Do I do all my data and da-da-da-da-da? Do I do some teaching out of there? Do I do all of my, I have my home studio there, out of there, and so on and so forth.
Yeah, because I run a record label from my home. I have a recording studio in my home. I do some online teaching. So that's why I was surprised
Yeah.
that I couldn't deduct this.
Yeah, I'm just wondering, there's a little flow chart that some people walk through. I'm wondering, I can send that to you.
Oh.
It's written for, mainly for W-2 wage earners, but if you shoot me an email, I'll send it to you, and you
Yeah.
could maybe sit down with your person.
We get 1099s, right? From here, so it's not W-2.
Yeah, okay,
So
yeah.
that's why I was surprised.
But yeah, he may have sort of decided that this was your tax home.
Sure.
Yeah, okay, you can have another chat. So I didn't mean to shut you down there with if you're shouting out. So please, ask other questions about what you might put on here. Yeah.
Can you once again please elaborate on the auto expenses? I know there's that mileage method, but then what if you didn't do the mileage method, but you spent $8,000 fixing your car? How much
Yeah.
of that can you write off, and
Yeah.
how do you go about it?
Great. So there is right here. There's this part 4, information on your vehicle.
Okay.
So you would need to fill out this portion, and there are kind of no wrong answers here. Like, was your vehicle available during off-duty hours? Like, yes, no, it's fine. Don't sweat these answers. Just make them real. Though do you have evidence to support your deduction? I would highly recommend that answer is yes.
Yeah.
And then as I mentioned, so what you'd have to include in here is your business miles, your commuting miles. Says see instructions. That's the chart, the workflow chart we're talking about. Like, what is commuting? Because commuting is not deductible. And then other is the rest of your personal miles.
Mhm.
So then, presumably, you would be using some tax preparation software, and when you entered in the business miles, the commuting miles, and the other miles, it would develop a fraction, a ratio, where the business miles would be the top of that, and the rest of the miles would be the denominator. So you drove 5,000 miles for business, 10,000 miles for other, so your denominator would be 15,000, right? So 5 for business and 15 total. So 1/3 of your miles were for business. Then you would have to enter into your tax software. There's no place on any of the forms. You would have to enter in, I spent this much on gas, this much on repairs, so the $8,000, this much on maintenance, this much on changing a new set of tires, this much on the new radiator, blah, 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 blah. And then it would say, okay, great, 1/3 all of that, you get to deduct. And then on top of it, there's that complicated depreciation calculation that would be added on top of the 1/3 of all of those expenses.
So using that model, would you have to keep all of your gas receipts as well? Eek.
Eek.
credit card and hold on to the
See it.
statements.
Yeah. So technically, a credit card statement is considered a secondary source.
Ah.
So you want the actual receipts whenever you can for any backup. A bank statement or credit card statement is like oops, I didn't save the receipt. Will you pretty please accept this as because your credit card receipt doesn't tell you like what it is, and for Washington state purposes, it doesn't show how much sales tax you paid. So the statements are not bad, they're just not ideal. They're not really what's gonna get you like sailing through an audit. Okay, so I want to move on to a couple other important topics. And I'd love to leave the the deduction questions unless anyone has any other thoughts about what might be deductible. Yeah.
Phone, internet,
Yeah.
services,
Yeah.
how would that?
Yeah. Here's a crazy thing. You're supposed to keep a log. Do you keep a log of your internet usage? Do you keep a log of your cell phone usage?
Wow.
Yeah, nobody does it, so don't sweat it. But you can't just deduct 100% of it because that's not reasonable, because you surely are using your home internet for like Netflix or whatever too. So it's not, I don't think it's appropriate to take 100%. But you could come up with like a log of, I know one person does it by how much time she spends in her home office versus how much time she spends in the rest of her house. Figuring she's always on the internet when she's in her home office. That's one way to do it. Or just take some conservative, reasonable amount. You can actually literally deduct the phone itself as long as it's primarily for the purpose of a business. Yeah.
Just one more, please.
Sure.
Okay, so what if you're paying like 2 rents? You're paying the rent in a place for your bedroom, but then you're also paying rent for another room which has your studio.
Mm-hmm.
How do you deduct that?
Okay, yeah, so that's perfect. I was just gonna move on to the home office deduction. So, there is, where did it go?
18?
Yeah. Yeah, so there's the rent here, but that is for specific rent. So if you rented like, either occasionally or consistently a space outside of your house, say like, oh, we just booked some rehearsal space, that would go there. Or my band, we like keep a storage spot that doubles as a late night jam spot, that would go there. But the business use of home deduction is all here. So just like the mileage, or just like the car, the business use of home has an easy method and a hard method. And also, just like the car, both of them required with the car that you keep a log of the miles, the business miles. For the business use of home, both of them require something in common, which is that you have to exclusively use that space for the business. Doesn't have to be an entire room, but it has to be like not used for anything else. And there are court cases with extreme examples. The favorite one I always trot out is, there was a court case where a guy had his entire basement dedicated to his business. He kept his life insurance policy in the bottom drawer of his filing cabinet, and he got called out by the auditor for a mixed use of the basement.
Got him.
Got it. He actually won in court, but he had to go all the way up, like through audit, through appeals, to tax court, which is why we know about his case, in order to win that, right? That's nonsense. He's lots of time and money just because of a stupid, life insurance policy. So you can see how strict it is. So I recommend taking, measurements of the space, a photo of the space, a video of the space, whatever you want, but just to indicate like, yes, this is dedicated to my business. And if you have that photo, that documentation, that makes it that much less likely that the auditor would want to come visit you in your house if you can just be like, oh no, here's a photo. The simplified method is you just figure out what the square footage is of the dedicated space, and you multiply it by the annual dollar amount, and then it's also capped. I've forgotten what that cap is. I think it's $600. Sorry, I don't have it memorized right now. Then there's the full-blown method, and it's very similar to the driving. So you take the square footage of the dedicated space over the square footage of your entire space that you rent or own, and then you apply that ratio, that fraction, to all of your operating expenses of your home. So that's rent paid, renter's insurance, utilities, or your mortgage interest, your property taxes, repairs, maintenance, all the stuff. And then just like the auto, after you go through all that math, you apply a depreciation calculation just to make it so that you have to employ people like me to help you because that depreciation calculation is complicated. Your tax software, your DIY home-based tax software can do that calculation too.
Valerie,
Yes.
is that applicable for renters?
It is applicable for renters. Yes, it is. Absolutely. So, if you're renting, like, what did you say, like a bedroom and then a dedicated studio?
Mhm.
So we would leave your bedroom out of that
Mhm.
because that's not a exclusively used spot.
Yep.
And then you would figure out the square footage of your dedicated spot, your business dedicated spot, and then that would be the square footage that's allowed in this deduction. Okay. There we go. Don't want to run out of battery. Okay. Please be charging. There we go. Okay.
You might want to, redo the screen just.
Oh, see, the problem with this thing is it's got lips on it, and my computer is just the wrong size. Let's try this.
Yeah. Do you want me to grab a music stand? Would that be better?
Thanks. I think I got it. Okay. Oh, wait, no. What happened? Oops, sorry.
Andrew Garcia over here.
I'm sorry.
Well, while that's going on, let me continue because you don't really need visuals for the next thing I'm going to tell you. So, I want to make sure that all of you are aware and familiar with self-employment tax. Who's heard of self-employment tax? Yeah. Okay. Cool. Do you know that it sort of generally just bites you in the butt, right?
Did I go out? Start working?
We touched it and it went into settings and I couldn't get out of them, so now I'm just restarting it,
Oh, okay.
or trying to.
Oh, and is the HDMI working?
It was until I adjusted but I realized that my power cord was not plugged in.
Oh, they knocked it out?
Yeah, because the lip on this thing is just the wrong size, so.
Oh, for real? I got something for you.
But it's okay.
It'll be better, because then you won't worry about losing your laptop. That's stands for you.
Okay. I mean, we don't have that much time left, so. So you're familiar with self-employment tax, but I just want to make sure that you understand. Oh, thanks. Great. I just want to give you the quick history or understanding of self-employment tax because I think it's really helpful to sort of grok what it is and how to prepare for it. So I've always made this fun little chart here. So when you're a wage earner, an employee, you get a W-2 every January, and you see there are a bunch of boxes, a bunch of information on there, but this is kind of a schematic of the important boxes. So box 1 is your wages, what you earned, and box 2 is the federal income taxes that were withheld from that. So you earned $1,000, but you only took home, $960, they held back $40 for tax. But actually you took home even less than that because they withheld other taxes too. They withheld Social Security tax and Medicare tax. And then what you may not know about happening behind the scenes is that your employer actually matched the amounts of Social Security and Medicare tax, put that all together, sent it off to the IRS and the Social Security Administration. And it's supposed to fund, Social Security and Medicare. So when you are a gig worker, freelancer, blah, 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 you're still working. So you still are subject to the Social Security and Medicare taxes, but you don't have an employer. So nobody is holding that back from your pay. So you, as both, like you're wearing two hats, right? You're both the employee and the employer when you're self-employed. So you have to actually be responsible for setting that money aside, the first Social Security and Medicare tax, both the employee portion and the employer portion. And all four of those buckets, employee, employer, Social Security, Medicare, are, when you add them all up, it's about 15% of the net income. So whatever lands on your Schedule C at the bottom here, after you add up all of your income and subtract all of your expenses, you're gonna have a bottom line here, net profit or loss from your business. Let's see if I can do that. That would land in this box. And so that is going to be subject to this 15.3% self-employment tax. And that is in addition to whatever income tax you're gonna pay on this income. So you need to be really, really diligent. Thanks. I think we're just gonna stay put for the moment, because we're not far from being done.
Okay, I just wanted to see your laptop slide, that's all.
No, I think we're actually kind of stable for the moment.
Okay, cool.
Thank you so much, though. You want to be diligent about setting that money aside, making sure that you don't get caught unawares that you're going to be paying the self-employment tax. I've even seen tax returns where no income tax is due. They have so little income that no income tax ultimately is due, but you still have to pay the self-employment tax. So this is gonna, and I'll show you why actually, here on Form 1040. When you calculate your income tax, you have all these possible credits against income tax, including the taxes withheld from your paycheck and so on and so forth. But then the self-employment tax actually kicks in after a lot of the credits. So it lands, you get your income tax bill, then you can have all these credits against it, and then self-employment tax pretty much has no credits that can be taken against to reduce the self-employment tax. So I said you need to be diligent about setting money aside to pay that tax, but you actually probably need to be making payments in as you go. IRS has United States really has a pay-as-you-go income tax system, so you can be penalized for not paying your taxes in throughout the year. I used to give a whole lecture on that. I now have a video that I send out to people, so you can watch it if you want. A video that I made in 2020 with really mediocre production values. But it is on, if you go to VMCPA on YouTube, it'll walk you through how to make those payments and why you make those payments. It's a little bit long. You might want to watch it in 1.25 or more speed. But the general idea is that you can pay a penalty if you don't make tax payments as you go. And there are a couple methods to avoid those penalties, so you can be confident that you've avoided those penalties. And one of them is to just pay based on last year. You can look at this total tax line 24, and as long as you're covering that across the 4 quarters of the year, you're probably in good shape. Or you can try to mock up a current year tax return and guess what your tax bill is going to be, and then pay in that amount as you go. It gets more complicated if you have wages, withholding from your wages, because those will help you pay your taxes. So you'll have to just pay in whatever the withholding from your wages doesn't cover. Okay, I feel like we've gotten pretty technical here. Let me just think for a second to make sure there's nothing else that I really want to hit. Yeah, I'm more interested in going off of your curiosity and what you want to hear about. I know you probably, there's some things where you're like, I don't know what I don't know. But the deductions, the self-employment tax, those are the two like things that I really love to hit for folks, and we did get those. So, yeah.
I was told recently that I personally need to go on the IRS's site and do fillable forms for my situation.
Oh.
And so I would imagine it's just this, but.
Yes, I actually printed these out off. You go onto the IRS website. I'm not online right now, so I can't show you. But the search box in the IRS website kind of sucks. So generally, I let Google do the work for me. So in your or whatever, search engine you're using. But type irs.gov into your search engine and then your search term, and you'll get to where you want to go much faster than if you put it in the IRS website's search tool. Also, word to the wise, always irs.gov. If you're not on irs.gov, you're on a fake scam website. I'm curious about why you were told to do the fillable forms. Do you have like a really obscure form that you're filling out?
No, I was just out of scope because I paid anyone any amount.
Oh, okay. Yeah, that's interesting.
And outside of an independent CPA was the other recommendation.
Yeah, right. I mean, it's obviously your taste, but I would probably be more inclined to use tax software, and I know that like TurboTax is evil. Like literally, they lobbied the government to make it so that they wouldn't, the IRS wouldn't make their own tax preparation software. They recently kind of lost that battle though. There is a way to file online on the IRS website directly, and for many Washington state taxpayers that will work. Not if you're a contractor, however. So that's a bummer.
So that's not fillable forms.
That's not fillable forms. They do have fillable PDFs though. So like this is not a fillable form, but I just printed it right off of the fillable forms. So yeah, all of these forms that I pulled down are fillable. And you can do it, but the thing, I just feel like if you're doing it fillable, you're gonna spend hours and hours and hours and hours, and I might be more inclined to use one of the half dozen software tools out there, even if it's kind of cost you like, $50 or something. I know $50 isn't cheap, but it's a lot cheaper than, the hundreds of dollars you would pay a CPA. So, or an enrolled agent, you don't have to go with the CPA. What other questions do you have? Yeah.
I did some W-2 work and some 1099 work in the state of Georgia.
Uh-huh.
How do I file that on my Washington taxes?
Oh, on your Washington State B&O tax?
Yeah, do I have to file two? Do I have to file a Georgia State one and a Washington State one, or?
So, Georgia is going to want to have you file a Georgia State income tax return. And then, again, I would probably use software for that because it's probably easier for you to use like prepare the federal income tax return and then like add on the Georgia, and the Georgia information is going to like suck the important details from the federal return and kind of make the Georgia subset.
Yeah.
As for filing for Washington State, that's a whole other deal. I'm going to ask you a personal question that you don't have to answer, but are you pulling in more than 128,000?
No.
Okay, then you're probably not going to need to sweat it.
Okay.
But in brief, what you do is there's what's called an interstate deduction. So you include in Washington State all of your revenues, and then you can back off revenues earned in other states.
Okay.
But it's actually more complicated than that. Like when you sell t-shirts it is literally that easy. Like I sold, $100,000 worth of t-shirts, 80,000 of them were sold out of state, so Washington State only gets to tax me on $20,000 t-shirts that I sold. But when you provide services, your own labor, that deduction for out-of-state income is actually kind of a complex calculation. But if your whole revenue is going to be less than the taxable amount anyway, then you probably don't need to like sweat the details of that deduction because none of it's going to be taxable anyway.
Yeah.
So, yeah.
I have a couple like orchestras that I only play with like once or twice a year, but they still list me as a W-2. Is there any way to make them be like a 1099 with like recording commute stuff, or is it?
Right. Yeah, right.
there, like,
Wouldn't that be
weird-
nice? You could take some deductions against that income, right? The trade-off though is that they're taking care of half of your Social Security Medicare tax, right? There probably is no way to force them into that because really there are many instances where everybody's treated as a contractor when they actually by legally should not be. The employee-employer relationship is generally defined by how much control the employer has over your work. And I think actually a lot of performers are actually W-2 employees because, or should be. They're not treated as such,
Right.
but they should be because it's like, they're like, you need to show up at this time and you need to have this rehearsed, this ready to go in this manner, blah, blah, blah. That's like, and we do not want you to substitute anybody else. And, the only thing that could kind of make you a contractor is that you're bringing your own equipment. But they're providing, they're kind of telling you the who, the what, the when, the where, the why. That's an employer-employee relationship, as opposed to a contractor, which is like, I need this stuff done. Can you do it? Great. And if you can't do it, you'll just sub in one of your people, right? Great. That's more like the contractor relationship. So, they're probably, my guess is the orchestra's like got strong-armed in like by one of their advisors to say like, don't get in trouble with Washington State Department of the unemployment insurance or with L&I. Treat them as as employees. So I doubt you're gonna get out of that one.
Cool.
Yeah.
Thanks.
Yeah. Yes.
Number 2-part,
Okay.
and it goes back to business profit and loss versus self-employment tax. So what if you have 1 year a loss for running your business? How does that apply, and does it apply to a self-employment tax? Can you leverage it against it?
Yeah, that's a great question. Self-employment tax does not kick in until you have at least $400 of profit on Schedule C. The funny thing is, once you have $401, then self-employment tax math starts at $1. I have Schedule SE up here. Let's see where to go. Nope. Where did Schedule SE go? Anyway, there we go. Yeah, so $400 or more. If it's less than $400, stop. You do not owe self-employment tax. But like I said, once you get over that $400, then the math starts at zero. So if you're in negative, then the self-employment tax just doesn't apply, doesn't exist. And that loss thing reminds me, I'll just tell you quickly that there is something called the hobby loss rules in the IRS universe. So what that tells us, there's a presumption that if you have losses showing on Schedule C for 3 out of 5 years, they're going to presume that you're not doing your activity for profit. They're going to say, look, this seems more like a hobby. So actually all those deductions we talked about, not allowed. Also, because you're not in business, you don't have to pay self-employment tax. So it's a lose because you don't get those deductions, but it's a win because you don't have to pay self-employment tax on that income. You still have to pay income tax on that hobby income. But I know people who, they run losses year after year after year, especially The kind of artists I'm thinking of are ones that are like making a film that takes years to make, or they're writing a really long novel or something like that. They could have losses in the early years and deduction, the income comes much later. That would be reasonable. So you can refute the hobby loss presumption, but you do that by behaving in a business-like manner. You have a good plan, you keep good records, you have a checking account that's separate just for the business, and so on and so forth. I saw you other questions, but I'm not sure we got to the second half of yours. Do you want us to come back?
I was kind of wondering, so how much, like, say you made $10,000 performing, but you spent $20,000 on your business, does the IRS look at you and go, whoa, dude, wait a minute now,
Yeah, so
$20,000 in loss, and only, when does that get funny for them?
yeah, so that's that hobby thing loss I was
Gotcha.
just talking about. Gets funny if you do that 3 out of 5 years.
Gotcha.
Yeah.
Thank
So
you.
1 year's cool, 2 years, 3 years,
Yeah, thank you.
yeah. Yeah. and-
A little bit related to that, a friend of mine turned 65 and she applied to Medicare and she was not allowed because she had netted 0 so many times that she's not in the system. She's SOL.
Yeah.
And it's just been a nightmare. So whatever, so don't use those deductions and do claim at least some kind of income, people. Otherwise, you're going to be up Schitt's Creek right when you need it. So it's just been a nightmare for her.
That reminds me that I promised you that I'd tell you where your health insurance was supposed to be deducted, but failed to do so. So let me just quickly do that before I forget. I know I see other questions out there, so
Is
I.
that the 1095 form that we're supposed to submit?
Yes, you probably receive a 1095A if you got your insurance on the Washington Health Plan Finder website. If you got like an assistant, it's called a premium assistance. If you got a deduction or a discount on your insurance, you definitely want to use that form because you'll need to go into your tax software and calculate whether you fully deserved it or not based on your income level. If you didn't take the discount but you did deserve it, then you want to put that into your tax software because you will get the discount when you file your tax return. If you got free health insurance through Apple Health or whatever it's called, then you got a cool deal, so there's no tax deduction because you didn't have to pay. So I see your question, but let me just quickly find where that deduction goes. It's right there on Schedule 2, I think. Where'd it go? I highlighted it so we would have it ready. Here it is. It's on the second half of adjustments to income. I did not highlight it. The self-employed health insurance deduction. So if you are self-employed, then your health insurance premiums go there on line 17 of Part 2 of Schedule 1. And it's a cool thing because it just means you get to deduct your health insurance. Like, it just reduces your taxable income. It's not going to reduce your self-employment tax, but it will reduce your taxable income. Okay, yeah.
So I have a note from earlier to basically, it's almost like a step-by-step. Do Schedule C, that then feeds into Schedule 1, that then feeds into the 1040. Is that not comprehensive?
That is the fundamentals, but it's not quite comprehensive because you also need to do Schedule SE, which is the self-employment tax calculation.
And where does that fit into the kind of order of operations?
Yeah, you have to do it after Schedule C because the Schedule C bottom line feeds into Schedule SE, self-employment tax. And also, the self-employment tax lands on Schedule 2 and then rolls up into the 1040. Also, there's something we didn't talk about because it's so complicated that you almost have to have tax software to do it, but there's line 13 on the 1040 here, qualified business income deduction, and that is Form 8995. That came around with that tax law that I told you came in 2018. That's about to expire here in 2025 at the end of this tax year. So when you're filing your taxes next year, you'll still get to take it. for this tax year, but then after that, we will see. But what this is, in very brief description, in 2018, Congress decided to drop the tax rate for corporations down to 21%. So they said,
That's
okay,
nice.
right, yeah. So what they said was, well, crap, that means every business on the planet is gonna become a corporation. And that is forcing a lot of businesses to do something that doesn't make like non-tax sense for them. So they came up with this really convoluted system called the qualified business income deduction, which is supposed to sort of effectively make the tax rate on our business income somewhat close to 21%. Doesn't really achieve it, and it's a highly complicated calculation. Roughly what it does is it takes the bottom line of your Schedule C and multiplies it by 20%, and that 20% becomes a deduction on your tax return. So you see the total qualified business income and then multiply by 20%, and that rolls up here into your qualified business income deduction on Form 1040. So that's more fillable PDFs for you.
Where does that fit in?
So you have to prepare Schedule C,
Yeah.
and prepare Schedule SE,
Yep.
and the amount of trader business income is reduced. Wow, we're getting super technical here. Is reduced by 1/2 of the self-employment tax that you pay. Because if you were an
Do not
employer,
see.
yeah, so the amount on Schedule SE, half of that is subtracted from your Schedule C income before you put it on the qualified business income deduction form. This is why CPAs never need to worry about having employment.
Wow.
Yeah.
Have it listed, please. Any
Also,
other- yeah,
if you
Lawrence.
made a retirement plan contribution, like to a SEP IRA for your business, that would also reduce the amount on here on Form 995. Are y'all like bleeding from the ears already?
Well, it's awesome. One more?
Yeah.
So can you deduct, or is there any way that you can, like, say your employer, you know, they take all the benefits out, they take your insurance, and can you deduct that? Yep, didn't think so.
No, because your health insurance is coming to you, if your employer's paying for that, it's coming to you tax-free already. You're not getting taxed on the health insurance premiums that you pay at your business, at your workplace.
Oh, because it's only a portion of what it is, right?
Yeah, even if,
Yeah.
like, so the part that they're paying, you know,
Yeah.
60% of the premium, you're paying
Sure.
40% of the premium, whatever, their 60% is not landing on your W-2.
Yeah.
And the 40% that you're having withheld from your paycheck is being withheld in a way that it's not taxed.
Okay.
So you're good. You've already squeezed out all the benefit you can from those health insurance premiums.
Okay.
Yeah. Yes.
So, I am a W-2 and I have 1099 work.
Yeah.
I get my health care through Health Plan Finder.
Mm-hmm.
So I pay a certain amount every month.
Mhm.
And then at the end of the year, they tell me that I owe $400+ a month retroactively for their subsidy, and that I have to pay tax on that as income.
It's not that you pay tax on it as income. It's that the subsidy is highly correlated with your income level. And so up until 2 years ago, there was like mid-COVID, they changed the law. But up until COVID, there was a really like a bright line cliff where if your income was above 400% of the poverty line, you didn't qualify for that subsidy at all. You're like $1 over that 400% of poverty line, and boom, you have to pay the whole subsidy back. Fortunately, during COVID, I think actually, yeah, I don't remember who promoted this, but anyway, the law changed where they made it a little more graduated, so it wasn't like this bright cliff. But nevertheless, if your income is too high, you have to pay the subsidy back. You're not paying tax on that subsidy, you're just literally giving the subsidy back. And so what you want to do whenever possible, they always encourage this, but who remembers to do it? But it is what you're supposed to do. As you go throughout the year, you're supposed to look at how much income you're earning and then go back to the Washington Health Plan Finder and let them know about the adjustment of your income. Oh, it's gone up. I don't deserve as much subsidy. And so then they're going to increase your effective health insurance premium. Does that make sense?
It does, I guess, as far as taxes are concerned. I don't understand how they could miscalculate $450 a month that now I'm supposed to pay back. Like, that's not a subsidy.
No, it's not. You basically, based on your federal income tax return, I can only assume that they realized you didn't qualify for that subsidy, and that's why you're having to give it back. Yeah, yeah. But whatever you do pay is eligible for the self-employed health insurance deduction. So if you're paying for your own health insurance, not at your job, but out of your own pocket through the Washington Health Plan Finder website, then you should be taking a self-employed health insurance deduction on the premiums that you pay.
So just on what I pay per month, or also do I get to tie in the end of the year, oh, by the way, you owe us this much more on top of that?
So I'm not exactly sure what happened to you there. Typically, I only know about the oopsie thing that happens as part of your federal income tax return. Usually you have to pay it back as you file your tax return, not the health plan finder is saying you need to pay more. But if the health plan finder folks are telling you to pay more, then I think they're just telling you, well, this year's premiums are higher than they used to be for you. So whatever you pay, what you need to do is get that form 1095A from the health plan finder website and enter that into your tax software and say, this is what I paid during the year. And then they'll see what you qualified for.
They said I owe this much, so the extra on top, I can claim towards healthcare expenses. Okay, thank you.
And just I'm going to be kind of persnickety there. So it's only the self-employed health insurance deduction is only for health insurance premiums paid, not for out-of-pocket expenses. So if you went to the doctor and you had to do like a $50 copay, that's not what goes on that line. The only thing that goes on the self-employed health insurance deduction is the health insurance premiums, just the monthly amount that you pay to the insurance company. Okay, well, I think we've gone like almost 90 minutes here. I wonder if your camera's still running.
It is.
Yep.
Okay, cool. Anything else before we wrap up and call it a night? Okay. If somebody wants the commuting chart, let me know. I can send that. And then also, I'm not looking for views. You don't need. I actually have a different YouTube channel that I'm looking for views on. But for the VMCPA on YouTube, there's only like 4 videos on that channel, and one of them is how to make quarterly estimated tax payments. So if you need something to help you fall asleep, go ahead and watch that. Okay, everybody, thank you.
What's the YouTube channel that you do want views on?
Oh, thank you. You're so kind. It's called You to Do You. In addition to being a CPA, I'm also a productivity coach. And I have kind of my own twist on it, which is that I'm really out to help people kind of improve their day-to-day experience. So I'm not about like, oh, here's this perfect productivity system that you need to follow, and here's how to be more efficient, more effective, blah, blah, blah. It's more like, how can you be fully yourself as you try to manage your schedule and your time and your tasks and your projects and life crap. So, yeah. Thanks, friends.
Thank you.
Yeah.
I wasn't able to put out the thing.
Oh, no problem.
Then they finished speaker.
Okay.
So